economy, this increase of 30 years of life expectancy took over a century. Zooming in on recent decades, if we look at the last 2 decades, I think this is a bit of a clumsy chart. What I want you to focus on the growth numbers. The growth has been steadily upwards. It has weathered waves of shocks, starting from Asian financial crisis to liberalization of the garments quota to global financial crisis, commodity price shock. Bangladesh has made steady and durable progress in terms of growth performance and weathered both domestic and external shocks, both economic shocks, also political shocks. So the growth drivers in Bangladesh has something deeply resilient quality about them. So we know that we have had a stable growth, but what has been the quality of growth? Here I showed you 2 charts. The left panel shows that the quality of growth has been relatively high. Inequality, of course, this is one form of inequality of consumption Ginies. During this growth transition, actually until recently in the first phase, our consumption inequality went down. It has went up a little bit. The right panel shows the performance of inequality relative to some of the peers. Here we have selected some of the developing and emerging countries, both from Asia but also Africa and Latin America, Indonesia, Tanzania, Sri Lanka, Philippines, Nigeria. They are not all low-income countries. It's low-income, middle-income countries. And as you see that we have managed to have this growth with a relatively commendable performance in inequality. Of course, some of it is policy, some of it has been the very nature of our growth drivers, which has been quite bottom-up. Here I would say that Bangladesh's growth has been bottom-up, and we can learn a lot of lessons from Chinese growth experience, which needed and received a lot of support from the top down. So this very growth, which has been steady, the quality has been quite high, has given rise to our social performance indicators performance compared to some of the regional neighbors. As you see, Bangladesh, even with the per capita income lower than India, our social indicators have been better than our neighbors, and obviously Pakistan, it has been better than Pakistan also. Yes. Now let's pivot a little bit to some of the macro structural factors. So we've talked about growth, quality of growth. Now looking ahead, what's the size of our financial system that can support investment and future growth? Here I show a very rough estimate of our domestic credit relative to GDP compared to some of the peers we talked about. The red bar is Bangladesh. As you see, we have a sizable, obviously this is not 100-200% of GDP indicators that you have in China, but compared to some of our peers, Bangladesh has a sizable, decent size of domestic financial system. Now we are working on improving the quality of the intermediation through this system. Here you also see that compared to the median emerging market depth, Bangladesh's financial system has reached a size bigger than those. In terms of the structure of the economic structure of the growth, this is based on our latest economic census. What we see, the left panel shows that trade and manufacturing has been driving a lot of the growth, and they also created jobs in cottage and micro and small industries. The left panel shows that our growth, unlike many other developing countries, have not been concentrated in select urban areas. The left panel shows growth has been driven mostly by rural areas. That has a big impact on the sustainability and the quality of growth. The right panel shows very much like our demographics. The economic entities are also young. 80% of our economic enterprises were formed after 2000, right? So there has been a surge of economic activities in recent years. Let's zoom out from the micro numbers. Here I show you few macro indicators that captures some of these patterns I had shared with you. The top left panel shows how our GDP has doubled since 2010. Now Bangladesh's GDP is around $250 billion. Per capita is higher than Pakistan. To give you a context of the size of Bangladesh economy, it's bigger than Vietnam's. The right panel shows, and it's a relatively interesting chart, the brown bars. The dot shows the red diamond shows the average growth rate of emerging market and developing countries who are at similar credit risk of Bangladesh. So what I want you to focus on 2010, Bangladesh's growth was very similar to those average peer economies. And then you focus on 2016-17, you see the divergence. Bangladesh has moved far ahead of them. We managed to achieve this growth without compromising macro stability. The bottom left panel shows the inflation performance. Inflation has steadily come down. Of course, that has been helped by the favorable commodity prices. The bottom right panel, the pink bar, shows that external stability measured by reserves as at a comfortable level. This is a crowded chart, so I don't want you to go through each of them. Here, 6th panel shows, as foreign investors, if you're looking at Bangladesh's economy to get a sense of the macro risks. Left means whether you look at through per capita income, debt level, fiscal flexibility, the leftmost you are, the lower risks you have. External finances, buffers against shocks, and external credit positions. These are countries which by the global rating agencies are rated at a similar level with Bangladesh, whether it's Vietnam, Costa Rica, Jordan, these are all similarly rated. And Bangladesh, in its rating category, this chart shows is sort of an underrated risks, meaning ingredients are placed with the movement of a few rating factors, Bangladesh can experience a ratings upgrade. Now looking ahead, what kind of growth are we having? Here our growth is somewhat similar to China. We have a strong manufacturing base. I think we can take pride in Bangladesh in a very decentralized way. We have one of the best drivers, as you have traveled to Haga, best drivers in the world given our traffic jams. Our entrepreneurs, we have one sitting in the delegation. I claim that our entrepreneurs were one of the savviest, just by the sheer nature of risks they managed and they have managed. The left panel shows that in a labor-intensive manufacturing growth, size of the available pool of labor is a significant constraint. As you know from your investors in Cambodia and in Vietnam, as soon as you go in fairly soon, you face labor shortages. Bangladesh has one of the largest labor pool, and what's unique about Bangladesh is the geography. Unlike India, it's not a 10,000 countries. It's a round, circular, concentrated country. So labor shortage is not an issue. Interesting thing is the wages. The wages, dollar wages, still extremely low, is 1/3 of Indonesia. And then the natural question is, what is the productivity of this labor? Sure, you have large pool of labor, but are they productive? Next panel, I try to answer that question. So we have ample labor productive. Here I should share with you two sets of information, one from McKinsey, one from JETRO. The left panel looks at the manufacturing total salary, not just the wage, but also takes bonuses, transportation allowances. Bangladesh is $1,500 per capita. It's 1/3 of Vietnam, 1/6 roughly of China. This is annual salary without looking at the productivity adjustment. How productive are Bangladeshi, our workers? The left panel gives you a sense of the productivity in comparable industry across countries. So Bangladesh, as you see, is 1/6 of Chinese wage, and our productivity is 80% of Chinese productivity. So if you do labor cost unit adjustment, there is significant room for cooperation between Chinese and Bangladeshi factories. Now again, looking ahead, As we know this, as China is industrializing, many other countries before, as they did, it will be vacating labor-intensive manufacturing goods. Here, the left panel shows global change in global market share in labor-intensive goods. Again, only 4: apparel, footwear, furniture, and plastic toys. Here you see that in the last, this is based on an internal IMF study, between 2010 to 2015, China's market share, China moved away from this low-intensive market share. Roughly, it left vacated 3.5% of global market share in these 4 products. Good news on the right side, Bangladesh picked up roughly 1/3 of it, slightly less than Vietnam. And I also want to submit to you that Bangladesh picked up mostly in RMG. We have not picked up much in plastics, furniture, or footwear. So the potential is huge. Now the question is that we often internally think about it, how long this trend continue. The right panel answers that question. As you know that China has 40% of the RMG market share, and Bangladesh is 6%, slightly less than 6%. If China vacates, or Chinese business wants to relocate to Bangladesh, not just to reach Western markets, but also bring back into the Chinese markets, couple of percentage points can drive Bangladesh's industrialization for the next 5 to 10 years. If we look at the economic history, the left panel shows you the Chinese market share in some of these 4 labor-intensive products I mentioned. In the last 30 years, look at Chinese market share in plastic toys, apparel, and footwear. Until 2008, it increased rapidly, and then China is now moving up the value chain, and it's now moving sideways. Looking ahead, if we look at other countries which went through similar transition, Korea and Hong Kong, the right panel, I share with you chart of 50 years in apparel export. As you see Hong Kong, the red line and the dotted brown line, you see that it went up till mid-80s and then rapidly declined. Chinese industrialization, it may not have exactly same pattern, will share some of these features, even though technology automation comes in. Again, this opens up huge opportunity of cooperation between Chinese investors and Bangladeshi entrepreneurs. For us, when we look at Asia and our own industrial future, what we have prioritized in our policy circle, we acknowledge that we need to significantly boost foreign direct investment. Now, as I shared with you, if you recall, a chart that our national savings is reasonably high. It's around 30% of GDP. Peer countries like Cambodia, savings is 21-22%. So we need FDI, not so much for savings, but for technology and industrial cooperation. And there is significant room for us to move ahead. As you see, that the black line shows during industrial transformation in East Asia, they attracted around 4% of GDP. Right now, we attract less than 1%. And that's where we need to move ahead. That's we are putting highest policy and national priority to integrate in the East Asian supply chain, to do with Chinese businesses what the Chinese businesses have done in Cambodia, Vietnam, and in Thailand. Yes, our FDI has not been very high. Here, what I want to share is that those who have invested in Bangladesh, they have heavily reinvested. So, which means the profitability in the sectors which we attracted has been pretty high. Looking ahead, I think that in the final electronics market, this is another place that we are looking at, that Vietnam and China has entered the market, and I think this is one place, electronics and automobile, we would be entering the space. Now, when look from Beijing or from other East Asian capital, when we look at Bangladesh, we often may not have sufficient appreciation of the economic dynamism. Here, I wanted to